So many investors out there love talking about Singapore REITs. That's mainly because of the passive income that they provide from their dividends. So if you want to get exposure to property in Singapore, as well as tap those passive income streams, all without the headache of dealing with the fees of actually owning a property, then it's easy to see why Singapore REITs are such a popular choice. Okay, so in this video, I'm going to explain what a REIT actually is, how Singapore has become one of the biggest REIT markets in Asia, how REITs can actually make you money, as well as the pros and cons before you invest. Finally, I'm going to end with how REITs should actually fit into your overall portfolio. Okay, so before I get started, if you want more straightforward money and investing content, then do like this video and hit the subscribe button. Okay, let's start off with what REIT actually stands for. It stands for Real Estate Investment Trust. And you can think of it like this. Instead of you actually going out and buying a property by yourself, like an industrial property or a warehouse, which could cost hundreds of thousands of dollars or even millions of dollars, instead, what you do is you pool your money together with hundreds, if not thousands of other investors, and you purchase those properties through a REIT. Effectively, the REIT uses that money or investors' money to buy, manage, and also rent out the properties that it owns. And that can be anything from shopping malls to warehouses, data centers, logistics properties, basically any type of property. So how do Singapore REIT stocks or share prices actually trade? Well, they are pretty much listed on the Singapore Exchange, so they trade like any other stock. And you'll be able to buy and sell them in real time on the Singapore Exchange. They are traded, remember, in lots of 100 shares, just like all individual stocks on the Singapore Exchange are. In terms of the distribution and what governs that, by law, Singapore REITs are actually required to pay out at least 90% of their taxable income as distributions to shareholders. That's why they're so popular among income-focused investors. These income payouts can actually be anywhere from, say, 4% per annum to 7% per annum, depending on the REIT. And some REITs pay out quarterly, and all REITs pay out at least twice a year. But do remember that dividends in Singapore are 100% tax-free, so that is one reason why they are so popular with investors here. So how has Singapore's REIT market evolved over the years? Well, it has become something of a REIT capital in Asia ever since Capital Mall Trust, which is now CapitaLand Integrated Commercial Trust, first listed its shares in 2002. And this was actually the first REIT that went public in Singapore. Fast forward to today, and the Singapore Exchange has over 40 Singapore REITs and property trusts listed on the local bourse, and they have a combined market cap of around 100 billion Singapore dollars. Okay, so what are some of the reasons for the extraordinary success of the Singapore REIT market? Well, first off, you have a strong regulatory framework. Remember, the MAS enforces strict disclosure and gearing rules on REITs listed here, and this gives investors confidence to put their money into the market. Second, you also have tax transparency. So Singapore-listed REITs don't actually pay corporate tax as long as they distribute most of their income as dividends to shareholders. Next up, there's also regional exposure as well as global exposure in a lot of these REITs portfolios. So a lot of Singapore-listed REITs don't own just Singapore assets or Singapore properties. They actually own properties that are located in places like Australia, China, Japan, Korea, Europe, even the US. So they're truly global in nature. And then finally, there's the investor appetite from the local population. Singaporeans love tangible assets like property, so REITs are a natural fit for that given their tax preferred status, as well as the fact that dividends in Singapore are 100% tax-free. So how do REITs actually make money? Well, property everywhere actually produces cash flow from renters or from people who are paying to use the property. So in that sense, it's really no different. REITs make money mainly from rent. And this comes from tenants in malls, in offices, in logistics warehouses, hotels, for example. And this profit or this rent flows through to the REIT's manager. Now, if you think of the REIT manager, you'll probably recognize a lot of these big names. REIT managers like Mapletree or CapitaLand or Fraser's Property. They take a small fee from all the profits for managing the properties. And that's similar to an agent managing a rental property for a landlord. And then they distribute the rest of the profits as dividends to investors. Okay, but like any investment, we actually want to see our capital or our money grow. So that is going to require REITs to actually grow their profits. Now, how can they do this? there are primarily two levers that they can pull. First off, there's rental income growth. Now, this is basically as leases come up for renewal, there will be rental increases or there will be an extra uplift in the amount of money they can get from tenants. And they can also carry out what's called asset enhancement initiatives, which is called AEIs for short. And this makes the property just better and more attractive to prospective tenants. And from there, they can perhaps charge more. And then number two, there is acquisitions. Now, this is actually buying completely new properties. And this usually requires the REIT to take on more debt or more leverage to actually fund it. Of course, they could raise some equity, they could raise money from shareholders, or they could use debt. So the way that they fund acquisitions is up to the manager. Of course, REITs, like any investment, can also lose money. So it's important to remember the potential downsides or the pitfalls to owning REITs. And the first one is if rental rates actually fall, then they obviously will take in less money from rent, and that will filter down to lower distributions to shareholders. The second one is if occupancy rates drop. So this is if the amount of space that they have to backfill from tenants doesn't get taken up. That means a lower occupancy, and it's basically wasted space that they could have rented out. And then finally, we have funding costs or interest rate rises. Now, remember, interest rates, when they're higher, debt is more expensive, and that is going to require REITs to put more of their money towards servicing their debt or paying interest on that debt. Because REITs have to borrow, nearly always have to borrow at least some portion of the money to buy new property. So they're always going to have some debt on their balance sheet. And the interest rate case has actually played out in 2022 when the Fed raised interest rates really, really fast. And we've seen a lot of the Singapore REIT unit prices, share prices actually fall. And that's because obviously you need to be compensated for holding a more risky investment, and REITs are considered riskier when you could be getting, or you could have been getting 3 to 4% on a Singapore T-bill maybe 1 or 2 years ago. Obviously, that's fallen now. And so there's a lot of reasons why some investors are now saying it's an interesting time to look at REITs because interest rates are actually falling. So what are some of the reasons that investors in Singapore love REITs? Well, first off, there's the regular income, right? REITs pay out regular distributions, whether that's quarterly or every 6 months. And this gives you consistent cash flow that you can use for your daily expenses or for your discretionary spending. Second, there's liquidity. Unlike physical property, you can actually buy and sell REIT units on the Singapore Exchange. If you actually owned a physical property, you won't be able to sell, say, the toilet or sell the kitchen to realize some of that money. So in effect, you can sell part of your holdings in a REIT, but you cannot sell part of your property. Third is diversification. Maybe you want to get exposure to commercial properties in Japan, and then maybe you want to get logistics exposure to properties in Europe. And you can actually have that by holding various REITs or different REITs. You can get exposure to 20, 50, 100 properties all in one go. And then you have professional management. You are the landlord, but you basically outsource the management of it to the manager, someone like a Mapletree or a Capital Land, and they will deal with taking in the rent from tenants. They will deal with all the maintenance issues and all that. So you don't actually have to think about doing any of that yourself. And then finally, there's accessibility. And I think this is a big point that a lot of people do miss, is that you can buy a board lot of a REIT, which usually in many cases costs a few dollars for 100 shares. So you can actually get started investing in REITs with as little as maybe $100 or $200. And so I think that makes it super accessible for people who are thinking about building a REIT portfolio or just a passive income portfolio of sorts. And this is obviously much more accessible for investors than buying a property outright. Okay, so despite the risks to owning REITs, which I outlined, REITs tend to remain one of the most stable and income-generating assets for local investors in Singapore. They bridge the gap between property investing and stock investing. So you get the relative stability of property alongside the liquidity of stocks, given a lot of them are traded on the Singapore exchange. And so that's why many investors have actually called REITs bond proxies, because in normal times, they don't tend to move much in price, but they give you a relatively attractive yield. Okay, so in a balanced portfolio, how much should you actually have in REITs? Well, REITs can actually complement your stock and bond allocation, but traditional asset allocation models and advisors suggest not having more than 10% of your overall portfolio in REITs, but it's common to see Singapore investors have actually a lot more than that. I would say that one thing to watch out for is that if profits do fall at REITs, that then their distribution payouts can actually fall as well, because they don't have a lot of wriggle room. Remember, they are mandated to pay out 90% of their profits as dividends to shareholders. So in effect, they actually have a 90% dividend payout ratio. And if you're thinking about traditional dividend stocks, that would be considered a very high dividend payout ratio, because there really isn't a lot of room to continue to maintain the dividend if profits fall. And that's exactly what happened in 2023, 2024, and even into this year as well. We're seeing a lot of REITs in Singapore trying to stabilize their distributions or their dividends, and some REITs are still seeing their distributions come down. Okay, so I hope you found that introduction to Singapore REITs useful. So if you found this helpful, hit the like button and subscribe to my channel for more insights.